America is facing a new debate. The government has committed $20 billion to support Argentina, and many people are trying to understand why this decision was made while the American economy is still under pressure. Business activity has slowed, borrowing costs remain high, and uncertainty continues to shape how companies and workers plan for the months ahead. In this environment, sending billions overseas feels unusual to many Americans who are trying to stay ahead in a difficult economy. So, many Americans are asking why the country would send $20 billion overseas right now. The administration argues that the decision is meant to protect the stability of the American economy and that preventing financial stress abroad can reduce risks at home. But that explanation leads to a bigger question. Why would trouble in Argentina create danger for the United States? And how does a crisis thousands of miles away turn into a problem for American consumers and businesses? To answer that, it is necessary to understand what is happening inside Argentina today. Argentina's situation begins with a simple but unusual reality. The country uses two currencies at the same time. Its official currency is the peso, but many prices and long-term savings are based on the dollar because people do not trust the value of their own currency. Over years of high inflation, the peso has lost strength again and again, so households and businesses rely on dollars to protect their money. This creates a system where the economy depends on a currency it cannot print. When dollars are available, the economy can function, and people can plan for the future. But when dollars become scarce, the peso weakens, prices rise quickly, and financial stress spreads across the country. As the peso loses value, investors begin to pull money out, and the pressure builds until the entire system becomes unstable. A shortage of dollars can trigger rising prices, social tension, and a wave of capital leaving the region. This instability does not stay within Argentina. When a major economy in South America faces financial stress, investors around the world react. Risk spreads through nearby markets, and uncertainty rises across the region. For the United States, this matters because volatility in South America often leads to swings in commodity prices, pressure in financial markets, and changes in global demand that affect American businesses and consumers. The dual currency structure makes Argentina highly sensitive to dollar flows, and when that system shakes, the impact reaches far beyond its borders. But understanding the structure is only the beginning, because the real question is why Argentina entered such a severe phase of instability so quickly. That instability began to grow as Argentina pushed a bold and risky plan. The new administration attempted to fix years of financial trouble by cutting public spending at a level the country had never experienced. Government programs were reduced, ministries were closed, and thousands of public sector jobs disappeared as part of a rapid attempt to control inflation and rebuild trust. At first, the strict cuts brought in some positive signals. Investors who had avoided Argentina for years returned with cautious optimism, and new dollars began to enter the country. But this optimism did not last. Political tensions increased, economic activity weakened, and confidence began to fade. Concerns grew as local elections showed declining support for the government, and public demonstrations added pressure to an already fragile environment. The uncertainty deepened when accusations involving senior officials reached the headlines, and investors reacted quickly. The peso began to fall, and each drop forced the central bank to use its limited supply of dollars to slow the decline. As more dollars were used, the country became increasingly exposed to financial pressure, and the possibility of a broader crisis became harder to ignore. Investors warned that if the situation continued, financial stress could spread through South America and create instability across the region. Argentina's economic experiment was designed to restore control, but the combination of political strain, slowing growth, and falling confidence pushed the system into a dangerous cycle. As this instability deepened, the United States decided to intervene and committed $20 billion to contain the pressure. Then where did that $20 billion come from, and how was it structured? The answer begins with a little-known financial tool inside the United States called the Exchange Stabilization Fund. This fund, often called the ESF, is controlled directly by the Treasury and can be used without approval from Congress. It was created to stabilize currency markets in moments of stress, and it holds enough resources to act quickly when global conditions become uncertain. For the support to Argentina, the ESF became the foundation of the plan. The Treasury used it to arrange a currency swap that allowed Argentina to receive dollars while offering its own currency in return. In simple terms, the United States provided dollars now, and Argentina agreed to repay them later with its central bank reserves. This structure allowed the government to say that the support did not use taxpayer money because the ESF operates separately from the annual budget. But the economic reality is more complex than the official explanation. Even though the support is labeled as a swap, it still places the United States in a position where risk cannot be fully avoided. If the situation in Argentina deteriorates and its central bank cannot repay the dollars, the United States must absorb the impact. A swap can be compared to lending money to a friend who is already going through a difficult time. The agreement may say the money will return, but the uncertainty remains, and the lender carries the risk if things go wrong. This combination of quick action and unavoidable exposure explains how the $20 billion was made possible. But understanding the structure leads to a larger question. Why would the United States accept these risks to support Argentina in the first place? The reason the United States accepted the risk begins with the role of the dollar. America depends on the strength of its currency, and a major disruption in South America can weaken the influence that keeps global markets tied to the dollar. If Argentina loses control of its financial system, other countries in the region may shift away from dollar-based transactions, and that change would challenge a core part of American economic power. Another factor is the flow of essential goods. South America supplies a large share of the food and raw materials that move into global markets, and instability in the region can lift prices quickly. A rise in grain or energy costs spreads through supply chains, and American households feel it almost immediately when grocery and fuel prices go up. Many families already face a tight budget, and another spike in essential costs would add real pressure. There is also the impact on the American farm sector. If Argentina collapses financially, global buyers may shift their purchasing patterns, and the value of American agricultural exports could fall. A change in demand for soybeans or corn would affect farmers across the Midwest, and the loss of income would reach equipment dealers, transport companies, and local businesses. Beyond food and agriculture, financial stability is another concern. Emerging market turmoil often spills into global markets, causing swings in commodity prices, currency values, and investor sentiment. These shifts can weaken American stocks, raise borrowing costs, and make business planning harder for companies across the country. Because of these risks, the United States viewed the $20 billion not as a gift to Argentina, but as a form of insurance. The goal was to prevent a wider disruption that could circle back to American consumers and industries. But even with that explanation, the decision does not erase every concern. Many Americans still wonder what this commitment means for them as the situation continues to unfold. That uncertainty is the starting point for the concerns that continue to grow across the country. Even though the support was designed to protect the American economy, many people feel that the burden could still return to them in the future. Prices for essential goods remain high, and households continue to manage the financial pressure built up over the past several years. In this environment, a $20 billion support package for another country naturally raises questions. There is also concern that this may not be the last time the United States becomes involved in a similar situation. If Argentina struggles again, or if financial stress spreads to another emerging market, the pressure to intervene could reappear. People worry about how often the United States will be expected to take responsibility when global markets become unstable. The structure of the support adds another layer of discomfort. The government describes the action as a swap, but many Americans see the risk behind it. If the other country cannot repay, the responsibility remains with the United States. And for people already feeling economic pressure, that possibility does not feel distant. It feels like another cost that could eventually reach them. These concerns explain why the reaction to the decision is complex. The support may act as a shield for the American economy, but it also introduces a sense of vulnerability for taxpayers. It is both necessary protection and a potential burden at the same time. And now another question emerges. What possibilities will the United States face as the consequences of this $20 billion decision move into the future? The possibilities ahead depend on how Argentina moves through the months to come. If the reforms succeed and stability returns, South America could enter a period of calmer financial conditions. A stronger Argentina would reduce the chance of sudden market swings, and the overall risk for the United States would decline. In that scenario, the support functions as intended, acting as a barrier that protected the American economy at the right moment. But the opposite path is also possible. If Argentina fails to restore confidence or faces new financial pressure, the demands on the United States could grow. A renewed shortage of dollars could lead to additional requests for support, and the weight of that responsibility would fall on the American side. The first commitment may not be the last, and the long-term cost could expand as the situation evolves. In the near term, the United States may gain a level of stability by preventing immediate disruption. However, the long-term impact is harder to predict. A support package of this size carries consequences that unfold slowly, shaping how global markets respond to future stress and how much responsibility the United States is expected to carry. Across the country, people are still trying to understand what this decision means for their own economic future. Some see it as a necessary action to prevent deeper risk, while others view it as a heavy responsibility that could grow over time. The discussion reflects the mixed feelings inside American society as the situation continues to develop. And so one final question remains. Will this $20 billion insurance chosen by the United States truly protect the American economy?